You might think that the economic troubles of a country far across the ocean have little to do with your daily life. But when that country is Japan, you would be mistaken. For decades, Japan has been a quiet giant in the global financial system. It is not just the world's fourth largest economy, it is one of the world's biggest lenders. Japanese investors, from large pension funds to small households, have sent their savings all over the globe, buying up stocks, bonds, and real estate. In fact, Japan is the largest foreign holder of US government debt, owning over $1 trillion worth of American bonds. This makes Japan a critical source of stability and funding for the entire world. This outsized role means that problems at home in Japan do not stay in Japan. They ripple outwards, touching financial markets from New York to London to Shanghai. When Japanese investors get nervous, they often pull their money back home, which can cause stock markets in other countries to fall. If they decide to sell their vast holdings of US bonds, it could push up borrowing costs for everyone in America, from the government to families buying a home or a car. This connection makes Japan's economic health a matter of global importance, a barometer for the world's financial weather that we all need to watch closely. For a long time, Japan provided a predictable and steady flow of cash to the rest of the world. This was possible because interest rates in Japan were near zero. This environment of easy money allowed investors to borrow yen very cheaply and invest it in places with higher returns. But this era is now coming to an end. Japan is facing a perfect storm of its own domestic challenges, from a rapidly aging population to sluggish economic growth. The decisions its leaders make in the coming months and years will have profound consequences, not just for the 123 million people living in Japan, but for all of us. The story of Japan's economy is therefore a global story. It is a tale of how interconnected our world has become, where the financial decisions made in Tokyo can influence the price of a mortgage in Texas or the value of a pension fund in Germany. As Japan navigates its difficult path forward, the tremors will be felt everywhere. Understanding these connections is crucial because the stability we have often taken for granted is being tested. The quiet giant of global finance is stirring, and the world is holding its breath to see what it does next. At the heart of Japan's economic strain is a simple but powerful problem. Its population is getting older, and it is happening faster than anywhere else in the world. The country is recording the lowest number of births in over a century, while its large elderly population continues to grow. This creates a severe imbalance. There are fewer young workers entering the workforce to support a growing number of retirees who depend on pensions and healthcare. This demographic crisis puts immense pressure on the government's finances, as tax revenues shrink while spending on social services soars. A smaller workforce also means the country's potential for economic growth is severely limited. This demographic challenge is made worse by Japan's enormous government debt. To support its economy and its aging population over decades of slow growth, the Japanese government has borrowed massive amounts of money. Its debt is now more than 2.5 times the size of its entire economy, the highest ratio of any developed nation in the world. For a long time, Japan was able to manage this debt because interest rates were kept at virtually zero. This meant the cost of borrowing was almost nothing. But now, as the Bank of Japan begins to raise rates to combat inflation, the cost of servicing that mountain of debt is starting to rise, threatening a fiscal crisis. These two issues, an aging population and massive debt, create a difficult trap. To stimulate growth, Japan needs more workers and more consumer spending. But with a shrinking population, that is hard to achieve. To manage its debt, it needs to either raise taxes or cut spending. But both of those actions could hurt the economy and be politically unpopular, especially with a large elderly voting bloc. The government has tried to keep the economy afloat with stimulus packages, but these have only added to the debt pile without solving the underlying structural problems that have held the country back for so long. This combination of factors has left Japan in a state of prolonged economic stagnation. While major companies have recently agreed to significant wage increases, for many years, wages for ordinary workers have barely grown, and when you account for rising prices, many people feel poorer. The Nikkei 225 stock index did reach a new high in early 2024, surpassing a peak set over 3 decades ago, but the broader economy remains fragile. The nation is stuck between its past success and a future defined by tough choices, with no easy answers in sight. For many years, international investors played a very profitable game called the yen carry trade. The idea was simple. Because the Bank of Japan kept its interest rates at rock-bottom levels, close to zero, investors could borrow Japanese yen for next to nothing. They would then take that cheap money and invest it in assets in other countries, like US stocks or Australian bonds, that offered much higher returns. They would profit from the difference, or the carry, between the low borrowing cost in yen and the high return they earned elsewhere. This trade pumped trillions of dollars into global markets, boosting asset prices and keeping markets liquid. This flow of cheap money from Japan acted like a gentle tailwind for the global economy. It helped fuel stock market rallies and made it easier for companies and governments around the world to borrow. However, this entire system depended on one thing: Japanese interest rates staying low forever. But now, that is changing. In March 2024, the Bank of Japan raised its interest rate for the first time in 17 years. While the increase was small, it signaled a monumental shift. The era of ultra-easy money in Japan is over, and the yen carry trade is beginning to unwind. When this trade unwinds, the effects can be dramatic and destabilizing. As Japanese interest rates rise, borrowing yen is no longer so cheap. Investors who had borrowed yen now have to buy it back to repay their loans. This increased demand for yen causes its value to go up against other currencies, like the US dollar. At the same time, these investors have to sell the foreign assets they bought, the US stocks, the European bonds, to get the cash to buy the yen. This selling pressure can cause stock markets to fall and can create volatility across the globe. The unwinding of the yen carry trade essentially reverses the flow of money. Instead of cash flowing out of Japan and into the world, it is now flowing back into Japan. This sudden removal of liquidity can feel like someone turning off a tap that markets had relied on for years. It increases risk and makes investors nervous. Global financial markets, which had grown accustomed to the steady supply of cheap Japanese money, now face a period of adjustment. The end of this long-running trade is a major reason why financial analysts everywhere are watching the Bank of Japan's every move with such intense focus. The end of Japan's era of easy money is forcing a major rethink among global investors. With rising volatility and the old reliable strategies like the yen carry trade becoming risky, people are looking for safer places to put their money. Some are turning to traditional safe havens like gold. Others, particularly a younger generation of investors, are looking at newer alternatives. There is growing interest in decentralized assets like Bitcoin, which are seen by some as a hedge against the problems of traditional finance, such as currency devaluation and the massive debts held by governments like Japan's. This shift in investor behavior is a direct reaction to the growing fragility in the global system that Japan's situation highlights. When a country that owns over $1 trillion of US debt starts to have serious fiscal problems at home, it raises fundamental questions about the stability of the entire system. What happens if Japan is forced to sell those bonds to pay its own bills? The result could be a spike in interest rates in the US and around the world, making it more expensive for governments, businesses, and families to borrow money. This is no longer a distant theoretical risk. It is a clear and present danger. The political situation in Japan adds another layer of uncertainty. Prime Minister Fumio Kishida and his government have faced low approval ratings, making it difficult to push through the bold structural reforms that are desperately needed. Issues like encouraging more immigration to counter the shrinking workforce or making deep cuts to public spending are politically sensitive and hard to implement. Without strong political will, Japan risks getting stuck in its cycle of low growth and rising debt, which only increases the potential for a future crisis that would spill over into the global economy. Ultimately, we must pay attention to Japan because its story is a preview of the challenges that other developed nations, including many in Europe and eventually the United States, will face. Demographics, debt, and the difficult transition away from decades of easy money are not just Japanese problems, they are global ones. Japan is simply confronting them first. How it manages this complex economic transition will provide important lessons for the rest of the world. Its struggles are a reminder that in our interconnected global economy, we are all in the same boat, and a storm that starts in Tokyo can easily reach shores all around the world.